Hi everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what social media is sharing out there. Obviously interject my financial opinions. It's going to be commodity, wealth building, and or financial related topics with my opinions sprinkled in to the mix. If you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. We do have a discount coming up on October 30th and 31st called Spooky. And you can check out the details below for that. So I posted up some of my own posts, and it's a good way to share it. Gold divided by the M2 money supply looks good for gold. And also I've got gold against total bank credit. So this is gold versus the M2 money supply. You can see we've broken the downtrend. We're getting what I call the green army to show up on the right-hand side. So we broke through, did a small little pullback with another large green candlestick on the right-hand side. So that looks really good for a potential move higher where gold is going to outperform the M2 money supply. And it could be a mix where gold goes up and the M2 money supply remains stable or goes slightly lower. I also have gold versus the total bank credit. It looks very similar to the M2 money supply. This is a double bottom. We're coming back up, and it looks pretty good of the last trading session that we're putting in on the right-hand side for that big green bullish engulfing candlestick of the two candlesticks before it. So that looks good. We've got the producer price index in relationship to the consumer price index. To me, it looks like a huge double bottom, and this is what it looks like. And this also has profound effects in the market here. So all the way since 1950 or so, we've had a producer price index underperform the consumer price index. So it comes down, 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 down. Think of that as your companies netting the difference to some degree. That's kind of your margins that the companies are getting to some degree. So you've got the consumer price index, which consumers are getting, and then you got the producer price index, and the margins are somewhere in between those two. That has declined steadily from 1950 all the way to the bottom of 2002. When you look at 2002, this looks like a bottom. You've got the lead-in pattern that I always look for. Bottom, bottom, and now we're coming back up, and we've pulled back from this resistance line that's running across at that high that we've pulled on back. If we bust through these two support or these two resistance lines, this line here and the bigger trend line above, what that is going to tell us is that the producer price index is now outperforming the consumer price index. Think of it as a very large inflationary push. When the producer price index outpaces the consumer price index, that is inflation. You can see in the 1970s, we had a big move in the early 1970s all the way upward where this outperformed. We had another big move from 2002 all the way to 2008. And those two big moves are the kind of the big foundation of those big commodity moves. This is showing us a representation of those big commodity moves. And yes, they still moved as this went up and kind of swang back to the top here. So this was a big commodity boom here. This was another big commodity boom here. We had our first wave of the big commodity boom here. And if we can break through all of this and get to the upper side of this, that world looks much different than the world that we've been living in since 1950. It's a completely different looking world for Americans. So let's watch this together on the channel. I'll post this every once in a while. And if we see a large move, and believe me, if we get a large move, you will feel it. You will take notice. Oil will go up. gasoline prices will go up, food prices will go up. You will feel it. So this could be bottoming where we're at, and we could see a large outperformance for the producer price index. And I honestly, guys, I don't want this to occur to Americans, but it looks like it could potentially be happening with this double bottom and eventual break to the upside. This is what the double bottom looks like prior downtrend, bottom one, bottom two. There's your kind of lead in, and then it goes boom, boom. You break it, then you get a pullback. We pulled back down here, and then you get a big move to the upside. So that is the pattern that I'm seeing, is this double bottom. The hit of the strong resistance here, we pulled back, and then I think we're going to break. Here's cocoa, wheat, soybean, and corn for charts. So cocoa futures look very strong. They're ripping to the upside. They're at all-time highs. I know a lot of people probably aren't looking at this, but here's your big squeeze, and there's your break to the upside, breaking basically everything. We've got wheat futures, nice big break in 2007, pullback. Then we pulled back in this consolidation, another big break, another retest, and I think this is going to take off to the upside after it retests here. We've got soybeans, that's above its big breakout level. We had a big break in 2008, and then we've stayed elevated since that time, and we could potentially head higher here over the next few years. Here's corn futures, another one that had a big break. Back in 2007, we've been at an elevated level ever since. We've got our first wave up. This is our pullback, and then we'll see if we see another wave to the upside in corn futures. So elevated levels in every single one of those. Cocoa futures looking the most bullish of the mix. And I'd say wheat looking the second most bullish. This is real estate data for September of 2023. I haven't really reported on this lately, so let's go through some of the data. This is active inventory, total listing count, days on the market, and median listing price. So active listing count, you can see that this is inventory if you want to hear it a different way. We're still at very low levels. Yes, we have been increasing in inventory since April. We've been upticking. But overall, we've been at very low levels in September of 2023. And this is all 2017, 18, 19 is all up here. 2020 is where we really drawed it down. We're still below all of those levels. We do not have a lot of inventory. This is total listing count. So these are the count that the numbers that are being listed. We can see that listings are very, very low compared to history of all these, even 17, 18, 19, 20, and even these low years of 21 and 22. This is days on the market. Days on the market is still relatively low. This isn't where we're not, homes aren't on the market for a long time. They're still at a very low level, 48 days. And you can see how that compares to 2021 and 2022. And then median listing price, you can see that we're kind of playing with 2022's pricing. It looks pretty flat year over year, 0.4%. We're still up, but it has been pretty flat in terms of pricing. So even though mortgage rates have shot to the moon, pricing has remained resilient. Days on the market has remained resilient. Active inventory is still low. And everything at this time is holding together for the real estate market. This is more information on housing starts, all employees, construction, and total construction spending. If we're going to get a slowdown, we would see it generally in the housing market. If we're going to get a housing-led recession, that definitely does not look the case to be. We would also see it in these metrics here, and that's why I posted these. So your housing units in terms of total units is right about, I'd say about the long-term average is somewhere around this area. I would say we're around that area average. This is 1358. And it looks like we're off the page just a little bit, but there we are, 1358. We move over to new privately owned housing unit starts here. And let me see if I can move this over so you guys can see it. There we go. There it is. Here, we'll go to the last one. This is upticking a little bit here for the past month. 1.35 million. It's about average. We've pulled on back in terms of the overall housing starts on the long-term basis, but again, the last month was up a little bit. All employee construction, if I can get that to move out of the way, that has also been creeping higher. If you can see it behind here, it's been moving up. It's not down. I don't know why that stays there. And then we've got total construction spending, which is also left to right. It's not really dipping. So there's no slowdown that I can see in total construction spending. Housing starts, they've slowed down a little bit, but they're around average. And all employee construction is still going up in terms of employees. So no slowdown there yet. Scrolling down, these are also more information on a potential slowdown. I know people are worried about a recession, a slowdown. I'm just giving you guys the numbers and the data here. This is delinquency rates on all loans, personal savings rate, and checkable deposits and currency asset level. So this is your delinquency rate. You can see that we are basically all the way about as low as you can. And generally this turns upward before a recession. Like 2000, it turned upward. It turned upward into just past 2006. And then the recessions were slightly after it turned upward for a good 4, 5, 6 months. So we haven't seen that turn upward yet. And again, we'll continue to monitor it and watch it. This is your personal savings rate. Generally during recessions or slowdowns, the saving rate increases. So it goes upward. So you can see when we get a recession, the savings rates increase during those time frames. We've been trending lower, which means people are spending their personal savings, or I should say the personal saving rate is going down. They're saving less money. And that's what we're seeing right now, the past however many months. Then we've got households, checkable deposits, and currency in terms of asset level. We went all the way up to about 4.5 trillion. We're standing at about 4 trillion. And that's an ungodly large amount of money. If you look at and compare this to any time in history, I mean, this is 2007, 08. We were at a very low level. This has a long way to go lower, which would be inflationary if that were to unwind. That's what we've got there. Here's the Kobayashi letter. He says, here's a chart showing all outstanding mortgages by their mortgage rate. Essentially, all borrowers have mortgage rates that are well below the current levels. In fact, nearly 30% of borrowers have a rate below 3%, which is less than half of the current rate. So this is your distribution of rates on outstanding mortgages. You can see that the majority of mortgages are below 5%. I mean, look at the majority over here. The vast majority is definitely below 4%. 4% is right here. You can see the majority of those are below 4%. And then it really goes down. There is some mortgages out here at the current rate of 7.63. And maybe some of those people are giving up and saying, you know what, I don't think rates are going back down. Maybe we get more borrowing up at the greater than 7% range. I don't know. We'll have to wait and see. Knock, knock, who's there? Physics. Physics who? Physics you forgot to do. And that is about electricity prices must rise by 70% to pay for more wind farms. Warning from UK's biggest energy generator comes after latest bidding round received no offers to build new farms. Well, it looks like renewables are not market competitive against fossil fuels. This is silver. Most likely will advance in two legs. First one should take it to $30, $32. The second one to 40 to 42 level, which makes up around 750, 80% from present, 75 to 80% from present levels. This is what he's got. This is the big bear flag and the potential move up to 40 or $42. That's what he's got for silver. This is gold futures. With just a few days left in October, here's gold flirting with putting in its highest monthly close in history. And that's going to be extremely bullish. So there it is. We can see that we could potentially put in the highest monthly close ever. And we'll see if we can do that over the next few days. Go gold. Another one, look at this 15-year platinum to gold ratio chart. It's ready to pop. There's the first bottom, comes up, you put in a second bottom, which we're basically doing right now. And I think this is going to break to the upside. Completely agree. I am utterly a big platinum bull and silver bull and gold bull and uranium bull and oil bull and natural gas bull, etc., etc. But platinum does look like it is very cheap and could be putting in a double bottom here. Platinum, one of the most undervalued metals. However, it still has 4 big resistances to take out before we can see a surge in price. I like it right where it's at. It's squeezing up. I buy at these levels, and then I just wait for this to break all the way through. That's what I do. So I've been buying this for a few years. I've purchased at all these lows, and even back in 2020, $600, $700 even. And I'm going to continue to accumulate in this little corner here until it breaks and runs. Even with gold's recent surge above 2,000, GDXJ is still in the red year to date. However, we've seen a notably bullish change of character in the month of October. Will gold miners be able to sprint into the green in the final 2 months of 2023? And there it is, putting in that other shoulder. Gold in a bear market seems to think so. Some seem to think so. This is gold in Chinese yuan, and I'm going to step through gold priced in different currencies from North Star bad charts. Look at this high here, all-time highs when priced against the Chinese yuan. Then we go down. Gold in Indian rupees, all-time highs. Then we go back, we go down. This is gold blasting to all-time highs in Japanese yen, all-time high. So what we're seeing in gold is a break against all these different currencies. And we're basically putting in that all-time monthly potential closing high in USD. What do you think gold's going to do? It's probably going to run against all these different currencies. And it's probably about that time. This is Grady. Another one was silver. He says, big picture, there's really only one trend line to watch for silver right now. Once this resistance line is cleared, it will be on its way. Generational opportunity. This is the 12-year breakout line that we're trying to break through that resistance for silver on monthly candles. This can happen quite quickly. So when we break through that resistance, which is 25-ish something dollars, it'd be a fun ride. Here's gold in Canadian dollars. Another one, all-time high. All-time high. And this is gold measured in world currency units at, guess what? An all-time high. So gold is breaking out against basically every currency. We're seeing it break out against the USD last. And I think we're going to get a big run in gold. Very bullish in gold. And all the other currencies. Here's another one. Gold in British pounds, all-time high. Everything's breaking. Everything. Position yourself accordingly. This is the U.S. national debt over the last 100 years. You can see that we were going sideways for a good portion of it. We had an explosion after 1982 in debt. And now it is going vertical. Get ready for very large numbers to move over short periods of time, because as you go vertical, you cover a lot larger distance in terms of the y-axis versus the x-axis. as you go vertical. This is Ty Martin gold setting up really good in terms of US dollars. You can see that we've broken out of this bullish structure, much like the other flag pattern that we broke back in 2019. Is there going to be some sort of stimulus, QE, yield curve control that's coming here in the short term? I don't know, but maybe gold's pricing that in, along with Bitcoin. And that's where I'm going to end it there, guys. So that's what I've got for today. Give me a thumb up for the content, subscribe to the channel. This was mainly a lot of gold and silver. I think they look very bullish in the big picture view, and gold and silver, specifically gold, is a leader for the commodity bull market. So it does lead generally, and then the other guys follow behind it. So if we see a big break in gold, the next step is to see a lot of these commodities start to break to the upside. So that's what I've got, guys. Hopefully you're having a good day. We'll catch you next time. This is Finding Value.